Have you ever felt like you're trying to decode a secret message when you're looking at a financial report? Yeah, it can get even crazier when a company decides to sell off a big piece of itself. All of a sudden, the numbers can feel like a total mess, and it's really hard to tell what's actually going on.
So that brings us to the million-dollar question, right? How are you supposed to figure out the real health and, the future of a company when it's right in the middle of a huge transformation? How do you separate the signal from all that noise?
Well, here's the good news. It turns out there's an accounting rule designed to do exactly that. Its whole purpose, its reason for being, is to draw a bright, clear line between the parts of the business that are sticking around and the parts that are heading out the door.
Okay, so let's get into it. The hero of our story today is an accounting standard called IFRS 5. Honestly, you can think of it as a tool that gives us a kind of crystal ball, a way to get a much clearer picture of what the company is going to look like after all the dust settles from a big sale.
So what is this thing really? Well, IFRS 5 basically lays out the playbook for how companies have to report two really important things. First, non-current assets held for sale. Think of a single factory or a plot of land. And second, discontinued operations, which is the whole shebang, like when an entire division gets sold. The goal is super simple: clarity.
Let's start with that first piece of the puzzle. What happens when a company decides, you know what, it's time to sell this one big thing, like a building or a giant machine? This is where that special held for sale tag comes into play. Now, a company can't just go around slapping a for sale sticker on whatever it feels like. Oh no, the rules are strict. As you can see here, it's a whole checklist. The asset has to be ready to sell right now, management has to be truly committed to the plan, they've got to be actively looking for a buyer, and they expect the deal to close within a year. It's a really high bar to clear.
And this right here, this is the whole point. The second an asset gets that held for sale classification, the company is officially telling the world, we're going to get our value back from selling this thing, not from using it anymore. It's a fundamental change in that asset's purpose. And this slide just illustrates the impact perfectly. Before, that asset was just buried somewhere in property, plant, and equipment, and you'd depreciate it a little bit every year. But once it's classified for sale, two huge things happen. One, it gets its own special line item so you can't miss it. And two, and this is the big one, depreciation just stops. Cold.
Now, this slide highlights a really strict but super important rule about value. The asset has to be on the books at whatever number is lower, what the company's books already say it's worth, or what they could realistically sell it for, minus any selling costs. It's a really conservative approach that basically forces companies to recognize any potential losses right away, not hide from them.
Let's make this real. Look at this example with Michelle Co's stamping machine. On the books, it's worth $14,500. But they figure out that after all the costs, they can only really get about $13,000 for it. Because that sale value is lower, they can't wait. They have to take that $1,500 hit and record the loss right now. Okay, so that's a single asset. But what happens when we're talking about something way bigger? Like when a company sells its entire rose-growing business or all its travel agencies in France. Now we're talking about a major business breakup, and the reporting gets even more specific. This gets a special name, a discontinued operation. And the key here is that it has to be a significant separate piece of the company. We're not talking about just stopping one minor product. We're talking about a whole major business line or an entire geographic region where you can cleanly separate out all the numbers.
And here is where the magic happens, right on the income statement. You can see it's literally split in two. You have a profit number for the continuing operations, that's the part of the business that's sticking around, and then, all by itself, a single line showing the result from discontinued operations.
And the reason they do this is just so powerful. It lets anyone, you, me, any investor, instantly see how the core business is doing, the part that's actually going to be there next year and the year after that, all without its results getting muddied up by the division that's being sold off.
But that one line on the main statement isn't the whole story, not even close. If you dig into the footnotes of the financial statements, you get the full breakdown. So in this example, St. Valentine is selling its rose business. And look at this. We can see everything that went into that final loss number. The revenue they made, all the costs, even one-time hits like losses on selling assets and paying for redundancies. It's total transparency.
So let's bring this all home. This whole thing, it isn't just about accountants ticking boxes and following rules. IFRS 5 is actually a powerful analytical tool for anyone who's trying to figure out what a company is really worth and where it's headed.
Seriously, understanding this stuff gives you analytical superpowers. It means you can make way better predictions about future profits, because you can focus only on the core business. You can see a company's strategy in real time. And maybe most importantly, you won't get fooled by a big, splashy one-time gain from a sale that might be hiding some real problems underneath.
You know, this quote from our source material just nails it. The whole reason for this separate presentation is to send a clear signal, a flag you just can't miss telling you, hey, these results from the part we're selling, they're not happening again. Don't build them into your models for the future.
So, the next time you see a headline that a company is selling off a division, you won't just see that big number. You'll know to go look for that clean split, to find the line between what's continuing and what's being discontinued. You'll know exactly where to look to find the real story of the business that's actually moving forward.